digital assets could have a real transformative effect on capital raising in the small cap space. The cost is dramatically decreased. And look, if your technology and your entity is really successful and you've got a lot of money going through it, awesome. Like, congratulations. Is on the front page of the Wall Street Journal. You can pretty much guarantee that everyone in the SEC are reading that. You haven't seen a regulator lay down, stake a claim and say, we're going to say we're the regulator of DeFi.
A few institutions are as feared in the financial world as the US Securities and Exchange Commission, a watchdog of the capital markets. Today, we're going to debunk the myth about this institution and speak about the future of regulation of tokenized securities and crypto. Welcome, Ashley Ebersole, former SEC Enforcement Senior Counsel, a prominent lawyer focused on digital assets, fintech, and securities. We are your all-time hosts, Boris Pikalov and Ross Shemeliak, and this is Stobox Interview, a video series where we bring industry professionals and rockstars to discuss the future of digital assets, crypto, and tokenization. Subscribe to the channel, hit the notification button, and view other exciting interviews on this channel. Ashley, thank you for being with us today.
Yeah, thank you all for having me. It's great to be here.
And now let's get to the point. Ashley, please tell us about your background and current activities.
Sure. I joined the Securities and Exchange Commission at the beginning of the year in 2015. And at that point, Bitcoin certainly existed, but I don't think that there was as much of a thought that there was a corporate finance side to cryptocurrency or digital assets, and that they would be used for fundraising. Obviously, within a couple of years, you got to the days of the ICO and a lot of capital being raised in the field, and the SEC responded in July of 2017 by issuing the Dow 21A report. That was issued by colleagues of mine on one of the internal working groups there that was dealing with these issues. And thereafter, obviously, enforcement began to take place in the fall of 17 and then throughout 2018. I was there for a few more years, and in October of 2019, I moved over to Bryan Cave Leighton Paisner, the law firm where I'm a partner now, and I continue to work with a lot of entities in the digital asset space, fintech generally, and securities, and assist them with dealing with these regulatory issues.
Thank you. And please share your experience in the SEC. How did you choose which projects to prosecute? What did the process look like? Because for most of us who is not in the jail currently, this is very mysterious.
Sure. The SEC cases matters can arise in many different ways. It could be that there is some sort of internal referral where someone in another division says, hey, I monitor this industry and we're seeing this problem. You should investigate it from the enforcement side. There's also a lot of matters that come in through what's called the tips, complaints, and referral system. And that is honestly, in the ICO space, that could be, investors who their ICO, the ICO they invested in failed, or they thought that there were problems with, that they weren't going to be able to get their money back or something, and they can then complain to the SEC and say, hey, this is what these guys are doing, you should take a look at it. Or news reports are actually quite a substantial way that the SEC finds out about something. I mean, if something's on the front page of the Wall Street Journal, you can pretty much guarantee that everyone in the SEC, or decent enough people in the SEC, I guess I'll say, are reading that or saying, I wonder if we should investigate that. That sounds like something that, would be within our jurisdiction and that we should take a look at.
That sounds interesting. And one of the things that should be noted is there are a huge number of ICOs and different kind of tokens offering going on. And then there is a decentralized finance of this space is developing very fast. And you obviously cannot prosecute every single process and token and see whether there are signs of non-compliance. And probably you cannot also be reactive because everything new pop-ups each day. So I wonder, does the SEC have a proactive approach and the vision for the future of the market? How is it going to be regulated in the future?
Yeah, I don't think the SEC in any instance is trying to prosecute every violation. But and especially in the digital asset space, the regulatory divisions of the SEC, I think one of the common complaints, including from Commissioner Peirce at the SEC, is that not enough regulation has been put out to tell people how they need to behave. And you should do this, you shouldn't do this, you can do this, you can't do this, that sort of thing. And so a lot of that regulation is effectively coming through enforcement, for better or worse, of enforcement laying down sort of boundary markers of this kind of conduct is illegal, this kind of conduct may be okay, it may be on the borderline, that kind of thing. So especially in an environment like that, I think that a lot of the cases that get chosen because perhaps they're an iteration of the technology or of the type of conduct that the SEC hasn't seen yet. And they say, we're going to file this action so that we say this kind of conduct, which we haven't really talked about before, is something we're going to say is illegal, or something we're going to say merits a close look by us when we uncover it. And then any future actor that behaves similarly to the entity that was subject to whatever the investigation or enforcement action was would then be on notice that they could be seen by the SEC to be violating the laws, or at least skating quite close to it.
So it's about choosing the cases from basically each use case or each type of digital assets and showing what is acceptable and what is not, and probably choosing cases that have enough publicity in order for everybody to know that it happened and for issuers to pay attention to it.
I think that's part of it. Honestly, also, there's just the practical limitations of what the SEC can do. It's going to be a lot easier for the SEC to investigate something that's occurring within the United States, or that's occurring within the UK or in the EU, and other countries with whom the SEC might have close relationships with their regulators. It's going to be more difficult for the SEC to investigate something if it's in a market like China, Russia, somewhere where the SEC doesn't necessarily have as close a relationship with the regulator. And so the SEC can send a request to whatever the entity is for information. But if the entity doesn't get back to it, maybe the SEC doesn't have as much leverage to sort of force it to provide information. So that's just a practical reality of it, that, if conduct is egregious enough, the SEC will work hard to find a way, that it can go after whoever the actor is. But like I said, at the end of the day, just practically, it's easier to investigate conduct in certain jurisdictions than in other jurisdictions.
I see. No, it looks like the game theoretic approach, when you need to create a general fear and choose more or less random distribution of who you prosecute, so that everybody thinks that they may be the next one, and so they don't actually take upon themselves a risk of being investigated.
I think so, and I think also, the SEC, part of the SEC's mission, and I think some in the digital asset space, some in the DeFi space, and fintech generally might disagree with this, but part of the SEC's mission is to promote capital formation. So, if you talk to Commissioner Peirce, if you talk to Valerie Skapanik, who is within the Division of Corporation Finance at the SEC and was the head of the working group that I was part of, they're very conscious that, look, if there's conduct occurring in a market that is conduct that we would go after in the traditional finance area, it doesn't so much matter that it's occurring within the digital asset space or it's occurring in the DeFi space or whatever. If it's conduct that should be punished, we're going to go after it. But at the same time, they're conscious of not making such an environment that really inhibits the growth of new technologies, and especially that inhibits the growth of them in the United States, or in markets that are supported by capital from the United States. Because we have a strong position in the United States has a strong position in the financial industry. They don't want to hinder that at all in these new technologies that are rapidly taking over, or at least growing substantially in the areas that they regulate.
Mm-hmm. So basically, you need the prosecution from the perspective of supporting capital formation in order to have an investor confidence, so that they're not afraid of putting their money into businesses.
I think that's part of it.
Markets.
I think that's part of it. I mean, at the end of the day, you want the industry to grow, but you want it to grow in the right way, right? You don't want it to grow in a way that, when people invest money in, whatever the industry is, digital asset, DeFi or whatever, they've got to do a mental calculus if there's a 20 or 30% chance I'm just going to never see this money again, and that kind of thing, and beyond any the standard risks of investing money generally, but that it might just disappear. And so there's a strong, that's always been the focus with the SEC. So the 21A report in the matter of the DAO was issued in July 2017. Several enforcement actions were filed after that to sort of, again, just stake out, yes, we said that if securities, we're going to consider them securities, and we're going to consider ourselves to have jurisdiction over these. So there were a few early actions to just say, ICOs. If you're conducting an ICO and you haven't registered it because it's an offering of securities, we're going to say that's illegal. After a period of time, I think the view, shifted a bit, and you'd see this in the cases that were being pursued, to where, okay, so we've now put out the word that participating in an ICO, conducting an ICO rather, without registering is wrongful conduct that we're going to punish. But I think then you started to see in cases that wasn't enough necessarily on its own to draw SEC attention to the point that there would be an enforcement action. It started to be, okay, there's an ICO, but there needs to be something else. There needs to be fraud. There needs to be, something that we would enforce against if it was in the case of a traditional security. And we're now saying this was an ICO. We're saying it was a securities offering, and you're doing this wrongful conduct that we've long said was illegal. So we're going to have an enforcement action against you.
And this wrongful conduct, it may be the insider trading, or is it simply the fact that retail people can invest without the file and registration statement, or what kind of cases you're speaking about?
I mean, it could be a range of things. I think you've got some of the cases right now that are, recent and prominent are cases that were filed a while ago, right? Like Kick. I mean, Kick was filed, it's not that recent now, but it was filed, quite a while ago, and then just came to a decision. And that was just an ICO, a Section 5 violation for not registering the offering. But the kind of conduct is, you raise money for an ICO, and then, the investors waited, and you never actually developed the technology. You didn't do what you said you were going to do. It's what in the traditional context would be viewed as like securities fraud. You took people's money and you didn't do what you said you were going to do with it. And I'm trying to remember all of the cases, but then you took it, you developed, you devoted it to other projects that you didn't tell the investors about. You took it for personal use, that kind of thing. And, that is wrongful conduct that the SEC regularly goes after in the traditional securities space. And they started to say, all right, an ICO, fine, we think that that's wrongful conduct to begin with, but you've also got fraud. And we're going to go after you for both the offering violation and the fraud.
I see. So when you have a limited capacity, what kind of wrongful conduct you go for? You choose the one which is wronger, so to say.
I think so. And then, yeah, I mean, that's part of it. I think the size of the offering
Mhm.
can also be relevant. I mean, you have something like, that's going to draw front page Wall Street Journal attention. That's something that, the SEC might see and say, all right, normally we wouldn't say, without fraud, we wouldn't say, we're going to go after this because it's a registration violation. But this is so big that clearly this entity has not gotten the message, and
Right.
we're going to go after it, and it's going to make publicity, and that's something that we want
Yeah.
because it gets the message out, not just because they want publicity.
Yeah, thank you for your insightful answer. It is very hard to do a virtual assets business in the US. So most of the exchanges or the utility token issuers screen off the US citizens. In your opinion, is it current approach to regulation correct? And is it going to change?
I think that you're seeing, I have several clients who I'm taking through this process, and yes, you have to step carefully, definitely. Can you raise as much money under the current mandates, in terms of like Reg A plus, other exempt offerings that you'd be able to if you just conducted an ICO with no rules? No. But at the same time, you don't have the risk of having a regulator swoop in and say, oh, that's great, you raised a lot of money, give us that money because that was an illegal offering and we're going to take it from you. So there's I guess an opportunity cost to compliance in addition to the cost of actually complying, like what and so I think that there's definitely an awareness on the part of the SEC that there's a lot of interest in these assets, and that a consciousness that they don't want the U.S. to be excluded from that. And I think that perhaps with the new leadership at the SEC, with Chairman Gensler, who has the technical background to be pretty well versed in all of these issues, you might see a greater interest in regulating and creating paths that are easier for these entities to raise capital. I mean, that's what you saw with Chairman Gensler when he was at the CFTC.
Yep.
He came in the swaps area was sort of, it was probably the best comparator at the CFTC to what ICOs were at the SEC. So to this unregulated space that a lot of capital was going through, both investment capital and just capital by the participants in the industry. And he came in and with the mandate of the Dodd-Frank Act, imposed regulation on the space. And I think he believes in the benefit of regulation, that it makes a stronger market, it makes a more orderly market, and it makes, in the end, a market that's better for investors. And I hope that that will push him towards, taking an interest in the digital asset space and working with the regulatory divisions to come out with clear guidance for entities to follow that will let them raise capital more easily than they have to at present. I mean, at present, they need to hire someone like me and sort of, like I said, walk carefully and you'll get there. But, ideally, I think everyone would rather that it's easier.
Yeah, because currently the problem is not only in the fact that you have to comply, but that almost, unlike with some other jurisdictions, almost all kinds of virtual assets would be deemed securities in the US. So for example, Ripple is being prosecuted in the US, but not in other jurisdictions, for example. So it's generally, and this refers, for example, to crypto exchange registration. You need to get money transmitter license in almost 50 states, except a few. And this is terrifically expensive and complex to do virtual asset business in the US at all. So probably it's not only about imposing regulation, but also in doing maybe more clear and more favorable lines for the industry, where actually we have securities and where we have assets that require less of regulation. I like, for example, the European approach to it when in the upcoming crypto assets law, when they say that you necessarily need to publish a white paper for investors, and you need to specify certain kind of information in it if you're issuing utility tokens. But Up to a certain extent, you don't need an approval for it. And this creates a flexibility for small issuers, especially for startup issuers, which are native blockchain native startups, which start with blockchain and with a token to do some test in the water, so to say, and develop a preliminary product without causing a large harm.
Yeah, and I think that that's an approach similar to what Commissioner Peirce has advocated for with her safe harbor, is that, you know, blockchain startups for the first few years of their life don't need to comply. They can work to get their products built and market ready. And then hopefully by the time, you know, they're ready to emerge from this sandbox or nascent period and, you know, subject themselves to regulation, they've got a working ecosystem. They've got an asset that could legitimately be argued to be decentralized enough that it's not a security, that the actions of the issuer of that asset are no longer the most relevant actions that an investor would look to when deciding, is this something I should buy or not buy? Because that's sort of what the touchstone of what will make it a security or not. But on your point about the money transmitter license, I mean, I think also FinCEN is undergoing, which is the US's financial crimes agency, is undergoing a transition from Director Blanco, who has been not unfriendly to the crypto space, to the acting director Mosier, who, you know, has an historical affiliation with Coinbase, you know, has again knowledge of this space that you would hope would lead him to have a careful and well-calibrated approach. Because, you know, like so far, FinCEN, I mean, has had the ability to go into the space and under the travel rule and file a bunch of enforcement actions. Obviously, you know, it's sort of not been there. That hasn't been what they've done. And I think it would be tough to do that when it's sort of a technological impossibility at this point to comply. You know, for FinCEN to go in and say, all right, well, that's fine. We're just going to file a bunch of enforcement actions, take your money, and that's it. And they didn't do that. And so I think that Acting Director Mosier, hopefully Director Mosier eventually, will continue that and might even, you know, be a little more accommodative, realizing the inherent difficulties of implementing controls like this in the digital asset space. And I mean, as to a nationwide money transmitter license, I mean, yeah, I think that there have been different proposals like this floated in terms of, you know, a fintech charter from the OCC and that kind of thing. So, you know, we may see some movement in that space. I would hope we do.
Yeah, I see. Currently, based on our experience, we see a big interest from the businesses to security token offerings. And from your perspective, what are the benefits of tokenized securities from the regulatory perspective? And are we going to see the regulatory enforced move to blockchain, as we have seen with the materialization of securities?
On some of our other interviews, so for example, with Douglas Borthwick from INX, which I encourage our viewers to see, he mentioned that the SEC recognizes the benefits of tokenized security from the perspective of transparency and AML compliance. We are going to see the enforcement from the SEC and other authorities to actually move the existing processes and accounting of securities to blockchain, to actually to improve the enforcement capabilities.
Yeah, you know, there's been about a little more than a year ago, there was a request for proposal put out by the SEC for a provider to come in and provide it with much greater blockchain capability to operate in the decentralized space than it then had technically. And so you may see you know, more of that coming. I think, look, I mean, blockchain is in many ways technology that is has a lot of benefits and seems almost tailor-made for transaction recording, in the security space. And, you've got a built-in timestamp, you've got, a neat built-in audit trail. So I think that the SEC definitely sees the benefits of it. How quickly you see a move in the direction of incorporating that in from the regulatory perspective. I mean, just to be honest, nothing moves that quickly at the SEC, but I do think you see recognition of it, and I think that will be a first step to hopefully seeing more incorporation of it, more accommodation of it from the regulatory perspective.
One of the widely marketed benefits of tokenized securities is enhanced liquidity. But as we've seen, most issuers actually prefer issuers of tokenized securities prefer going under exemptions, such as Reg D, especially to reduce costs, and are not able to file S1. So are there actually ways for issuers that raise capital under exemption to create some liquidity, for example, under the section 4A1 or anything like that? And would tokenization actually make it easier, on your opinion? Because currently the secondary markets are only developing.
Yeah, I mean, I think that there are ways to do it. I think that, you can obviously increase the amount of capital you can raise by doing something like a double-barreled Reg S and Reg A plus offering, and that kind of thing. And, then yes, there might not be immediate liquidity, but after the, restrictive periods, for these securities have run, then, yes, there could be more liquidity. I mean, I think that, it also depends if you're talking about onshore or offshore liquidity, in terms of in the United States or offshore. And I mean, those are, two different considerations. I think that, obviously what you probably want is total liquidity. And so you would rather have, a unified market that can offer that. And, hopefully we're moving in that direction. I think that at present, the greatest liquidity is in, coins that are trading on a global market, obviously.
So you think it's about the cross-border collaboration and cross-listings on different exchanges and different venues around the world, and maybe in countries where there is less restrictions on trading, especially under the exemptions?
I think that has a role to play. It's tough to say from the SEC's perspective. The SEC is going to say if it's trading in the United States, it's being offered in the United States, then, we're going to say it has to comply with our standards. And so that'll get you to a point to have, an international component. But, it's got to be done the right way, I think, is the lesson, from the SEC's perspective.
Mm-hmm. One of the things we are seeing with this request for liquidity and the virtual assets and generally everything moving is that the power on capital markets overall is moving from Wall Street to Main Street. We are seeing more participation of retail investors and more desire from retail investors to participate in private placement, in startup investment, even in some sophisticated instrument as well. And we see them utilizing some sophisticated tactics, such as short squeeze, as we've seen with the example of GameStop. And I wonder how will we live in terms of regulation, in terms of how market developed in this new era, when retail investors participate more and want to participate more, when we have the forums on Reddit deciding when the price is going to move, and when we have large scale collaboration of hundreds of thousands of people doing market manipulation, which would be punished in the case if we would have one person doing it. And when we can see companies having their P/E ratio more than 1,000, like in the case of Tesla. So how we would live in the world when Main Street rules capital markets?
Yeah, I mean, I think that, the Reddit situation was, obviously part of the reason that it was created so much news is it was something that the SEC had, I don't know if they'd necessarily, envisioned something like that occurring. Someone probably had, but, it wasn't, but, at present, I mean, I think that most people in the security space who look at that, see there was a lot of attention paid to it. You would say maybe like a lot of smoke, not necessarily any fire. There weren't clear securities law violations occurring. If, based on the facts that as they were represented by GameStop and by Robinhood, there were restrictions that were incumbent on Robinhood to put in place on trading stops and that kind of thing. And there was an unfortunate reality to that for some traders. But that wasn't necessarily violative conduct that's going to bring, an SEC action. I mean, could it? Yes. I mean, I don't know all the facts. I don't think anyone, except maybe, a small coterie of people necessarily know all the facts. But, I think that look at the SEC, investor protection, including of retail investors, has been a top priority for enforcement, for examination of entities, for several years, maybe, almost at the beginning of those priority lists being published. So that is always going to be a focus of theirs. I think that the digital asset industry, in particular, is, as the SEC begins to hopefully regulate it, it's going to look at it from, making it more efficient for entities to be able to raise capital in it, but also making sure that that is not done at the expense of retail investors. In the end, the SEC is a regulator of information. So as long as you're getting the information out to investors that the SEC says you have to, if an investor makes the wrong choice, in terms of, they invest in something and it goes down and there's no fraud and there was no imperfect information provided, the SEC, that's not a place that the SEC is going to take an action. An investor can lose money and it's not an SEC, securities law violation necessarily. But you would want it to get to a place where the SEC has clear regulations that say, this is what you can do. And when you do it, this is the information you have to put out there, including so that retail investors can intelligently participate in this market.
My view is that probably the general landscape of capital formation, especially for smaller issuers, is going to change and evolve. We had a previous conversation, which I encourage our viewers to watch, with the ex-director of NASDAQ, who mentioned that generally capital formation for smaller companies, for smaller IPOs has suffered because the margins of market makers have been squeezed by the introduction of electronic trading, and therefore they have less incentives to support the trading of small cap issuers, and that we need new kind of investment bankers and financial advisors focused on such kind of companies. And I think that what we would have in reality is that we would definitely have new advisors, even such as us at Stobox, focused on smaller issuers, on small and medium enterprises, but the underwriting and the participation in such offerings would be vastly different from what we've seen into the traditional investment banking world. Instead of guys in suits going to other guys in suits in high tall buildings, being institutional investors in the drone show, we're going to see road shows now being conducted in Twitter, in YouTube, by new kinds of influencers gathering investor audiences. And we are going to see basically Twitter influencers serving as underwriters. In the world of crypto, we are currently seeing that influencer marketing is one of the strongest and the most efficient solutions, basically with Twitter influencers being the analog of investment bankers from the traditional world. And I think that it's very hard to see what kind of regulation we would have to impose on them, especially on the guys who are anonymous and who are providing currently, as we're speaking, an investment advice.
Yeah, I mean, I think so. A few things. I mean, I have long had the view that digital assets and coin offerings have an important role to play given the issues you've talked about with small cap issuers and the economics of raising capital in the small cap space. Obviously, especially if you're a blockchain, based business who can do all of that in-house, develop the tech, conduct the offering, get the assets out there itself without the cost of, bringing in a financial institution to execute that for you, the cost is dramatically decreased. And so if you can, make that more broadly available, I think that, digital assets could have a real transformative effect on capital raising in the small cap space. In terms of investment advisors and that sort of thing, I mean, I know what you're talking about, influencers and the roles that they play. The most applicable SEC restriction would be the anti-touting restrictions. So all that those say is if you're being paid to say something favorable about a security or provide publicity for it, you have to disclose that, because you can't have people thinking, oh, this must be such a great security because look, all, this person, all putting out publicity for it and talking about it, say they're investing in it and that kind of thing. That's fine, but they all have to say, I was paid to say this, I may have received money, little tagline, whatever it is, that has to be disclosed. In terms of, anonymous voices saying those things, I mean, I think that is the space where you could see, a market manipulation charge by the SEC potentially, or, definitely a touting charge if, they can go and trace maybe a Bitcoin payment from the issuer to a wallet, and you try to put a face on that wallet. And so you go to the wallet provider, if there is one, if it's not an unhosted wallet or something, and you investigate, okay, you try to connect, there was a payment made. That person then gave publicity to this security, and they did or they didn't disclose it. If they didn't disclose it, then it's a touting violation. So I think that there's some basic things that the SEC would look at in that space, because you're right. I mean, there's not an obvious way to police that area.
The last topic that I would love to discuss, and this is probably one of the most complex, is about the impact of decentralization. Because what we are seeing is that the activities that have been previously conducted by regulated institutions currently can be conducted by the technology. We may have securities custody on the decentralized network hosted by 1,000 providers, or we can see a decentralized, for example, investment protocols working like the collective investment scheme. And I wonder, do you have an opinion on how can the regulation of these decentralized protocols that should potentially be regulated look like? And have there been any talks on considerations on that matter?
I think that I've actually got it's funny you're asking this. I'm about to publish an article about this. I think that you've seen, you haven't seen a regulator yet in the United States come into the space and sort of lay down, stake a claim and say, we're going to say we're the regulator of DeFi, or we're the regulator of non-fungible tokens or whatever. And I think that part of the reason for that is, especially with DeFi, depending on the technology, there are so many different, and the function it's performing, there are so many different potential regulators of it. If it's InsurTech and it's being offered on a decentralized basis through a DApp or something, you could have FinCEN looking at it because of the money going into it and out of it. You could have state insurance regulators looking at it. There might be, something more from the federal level. Same thing with, securities that are being traded. I mean, again, you've got FinCEN, you've got SEC or CFTC, again, state securities regulators potentially, depending on the size of what's going on. I think that regulation is coming, especially in the money laundering, anti-money laundering,
Mhm.
financing and terrorism space, you had the Financial Action Task Force put out guidance within the last few weeks that they had draft guidance out already on virtual assets and virtual asset service providers. And in the newest draft that they just released, you had the definitions changed sufficiently that it now seems to also encompass investors, developers, entities that are active in both the DeFi space and the non-fungible token space, which makes sense. I mean, you can't. I think that entities in this space would do well to realize that, especially, look, if your technology and your entity is really successful and you've got a lot of money going through it, awesome, like congratulations. But at the same time, as that amount of money grows, the regulators are it's gonna come to their attention. They're gonna start taking a closer look, and they're gonna figure out a way to regulate it, because when that amount of money is changing hands, they kind of want to know who's on both sides of those transactions. So, I think the point of the article I'm about to release is, at the very least, entities in this space would do well to put in place basic KYC and AML and counterterrorism financing controls, so that if FinCEN or another financial crimes regulator approaches them and says, hey, we noticed you've got a lot of money coming through your DApp, or we noticed that your NFT offering raised a huge amount of capital. We want to know, what controls you have in place. If you can just say, okay, well, yeah, we thought about these issues, carefully, and these are the controls we have in place. Let us know if we should have others, but we've made a best effort to comply. And in that case, the regulator is a lot more likely to say, okay, well, these people have thought about it. They've been able to provide us some information, rather than it looking to the regulator like they haven't thought about it and we think they probably didn't think about it, or they may have thought about it and decided we're not going to comply because we don't want to, because we're trying to break the law or something. You don't want to give them the wrong impression. It would be a lot better to be able to say, we thought about these issues rather, and we've decided to try to comply in this way, and let us know if we need to do something else. But in the meantime, don't we're not the people who you should have an enforcement action against. We're not the people who's you go in and you take their entire fundraise. I mean, that's what everyone wants to avoid, right?
One of the interesting questions here is who actually needs to be regulation. And this is maybe seen on the example of liquidity pools on Uniswap. So basically, Uniswap is not an exchange, as people are saying. This is common to see in different articles, but this is wrong. This is actually a decentralized liquidity protocol, which anybody can use to create their own. It's not even exchange, it's rather a market making pool. So basically, each issuer, each business becomes a money transmitter. And what we have, if this is with the common utility token, so what we have basically is that the business, and this may not necessarily be a blockchain focused business. I am a big believer in traditional businesses adopting digital assets, for example, for their loyalty programs, like Starbucks doing tokenized loyalty points. And this means that we should either have each of these businesses have some basic recognition as a money transmitter, which, as we know currently in the US, is complex, or we need a Uniswap themselves to have some kind of license. But again, it's questionable whether they should have this license, given that they do not control these liquidity pools. They simply provide the technologies that issuers themselves can use. And this is especially complex, taking into account that many of these companies and users of these companies are anonymous. That is, we don't even know whether they violate securities legislation, because we don't know whether they have clients from the US. So this is a very complex issue to tackle.
Yeah, agreed. And I think that with something like that, the FATF standards that have been released, and they're not final yet. They're still draft standards. They've got to go through a comment period, and then at some point they will revise them probably, and then issue final standards. the FATF standards would say not only, the entity Uniswap is someone that we're looking at in terms of a compliance responsibility. We're going to look at the developer and was compliance necessarily built into the design of, whatever this product is. We're going to look at the people who are funding them, the financial sponsors, private equity firms, whatever, and say, when they were putting money into this project, were they requiring that there be a compliance aspect, envisioning that, vast amounts of money were going to change hands through this technology? Did they require that compliance have a seat at the table, basically, and how it was designed? And I think that, so you see in the FATF standards, which FinCEN, once the final version has been released, FinCEN and most countries' financial crimes regulators will adopt their own regulations to, sort of be uniform with the FATF recommendations. And if they stay how they are now, I think that they will reach a much broader pool of potential regulated entities that they're going to say have compliance responsibilities beyond just like the Uniswap itself. You're going to look to their developers. They're going to look to their financial sponsors that provided them funding. And so in that way, try to, take a holistic view of it and try to get to someone who will, force KYC and AML controls to be put in place, is my view of it. And I think that, that's sort of what comports with the current state of the FATF standards, assuming they don't change dramatically.
It would be great to see it done in the collaboration with the industry. In Ukraine, many of our team members, including the founding team, are in the Ukraine. The Ministry of Digital Transformation gathered the foresight to foster the industry collaboration, which consisted from people from different government authority, from different business authority, to discuss where do we actually want the industry to move and how we want it to be regulated to combine the promotion of the innovation, protection of consumers, and the take into account the for example, FATF requirements, etc. And I assume that industry may have answers to it. The answer may be to have much of the compliance built on chain in order to make it cheaper for companies to comply and not have to feed the army of the lawyers and accountants, to have maybe compliance become progressive. So dependent on, for example, for the basic size, you need to introduce only KYC AML. And for more complex, you need maybe some additional licenses, things like that to actually happen, to have different stakeholders come to the agreement, especially given that we may have so many different regulators involved in even in a single case.
Yeah,
and we need technology expertise for that.
Yeah, I agree. And I think that that's the point of the comment period, is for entities as well as, national governments to submit comments. And, the more progressive of the national governments in terms of their thinking about digital assets, especially, could lodge their opinions and maybe move the needle, a little bit in the direction of the industry. The industry certainly will be advocating for that. And yeah, I think, this is something, like you said, that lawyers do, we will file comments, for entities that want to make them, and things like this. Doesn't cost that much. But, yes, there is a cost involved. But, people can write their own letters and that kind of thing. And they'll accept those. So hopefully through voices being heard on the regulatory side and from the industry side, the ultimate outcome of this will be something that I think, both sides can live with. It's accommodative enough not to stifle the industry, but it also has enough power to do what the regulator and the global AML regulatory regime needs it to do to meet their requirements.
Ashley, thank you for the exciting and insightful interview. We usually have our interviews between 35 and 45 minutes, but this one has been longer because it was so interesting to ask and hear your replies. So thank you for being with us today.
Sure. No, it's great to be here. Thanks so much for having me. And anyone who wants to reach out, Ashley Ebersole, and I'm at bclplaw.com. Brian Cave, Leighton Paisner. I love to talk about these issues, so reach out if you want to have a chat. And thank you guys again for having me. This was a lot of fun.
So yeah, thank you our viewers for being with us today and watching this interview. Please don't forget to like it, share it with your contacts for whom it may be interesting, insightful, share it in your communities. Please don't forget to subscribe to the channel if you're new, and see you in the next episode.